Hey friends, it's that special time of the month where we do Misfit Monthly here on Investing Unscripted. I'm Jason Hall with Tyler Crow. Hey Tyler.
Jason, you sound so subdued and very it's like you went from your normal investing pod voice to your NPR investing pod
Well,
voice.
no, that's it. I moved from like sports talk radio to NPR.
Okay.
That's right. Okay, Mr. Schweddy, you want to tell us about your boss?
If that makes it into the podcast, I will be delighted.
Of course, I'm not taking it out. Our executive producer, Jeff Santoro, he may make an editorial decision there. We'll leave it up to him. Let's be honest. He's not even going to listen to this. It's going to make the
Probably
final
not.
cut. All right, Tyler, I'm excited. This is our third episode of Misfit Monthly. So we've made it farther than either one of us expected that we would.
Yeah. And, the funny thing was as a little behind the curtain of media production that Jason and I did, which basically meant 30-second conversation a little while ago. I came up with an original idea, and Jason was like, you're just really too much in your own your own little world here. Nobody cares about what you want to talk about. So we had to make a slight pivot from Tyler's angry rant at clouds for the day.
So it's not that nobody cares. It's that
No,
not
you're
enough
right. One
people
person
care.
cares, and I'm the only one. And
I
nobody
do
else wants to
think,
listen to it.
Tyler, we will eventually do an episode on our obligations as shareholders to the companies that we own. But we're not going to do it this month. Dude, there is so much going on since the last time we recorded that I think it's time to talk about tariffs and misfits, unexpected and misfits, in an episode that I'm tentatively calling Misfits Monthly 3. Nobody saw this coming.
That's we're starting to get into that weird play on words of the Fast and the Furious titles here, because I don't know, maybe by 5, everyone will be like, man, this is getting old.
Yeah, we won't even be calling it Misfit Monthly. We'll just be calling it MM.
There we go.
Right. That's the direction that this is going. All right, Tyler, I am excited to have this conversation because we're going to get a little bit into the weeds, but we're really going to focus on kind of the blocking and tackling of what these companies. So again, for those that haven't heard either of the 2 Misfit Monthly episodes that we've done so far, or heard you on when we've had you on talking about your Misfit Alpha newsletter, I think we should just start there just with that introduction of your work with Misfit Alpha. Go to the description and you can find a link to Misfit Alpha. There's some free content there, but most of it's behind the paywall. With the link there, if you decide to subscribe, you can get a discount. So I encourage people to check that out. But Tyler, just what's the elevator pitch for what Misfit Alpha is and what you've been doing with it?
Well, Misfit Alpha, it's kind of like an investigation into what has worked in terms of companies that have wildly outperform the market over the long term, with a real focus on the ones that nobody seems to talk about, and trying to, build the connective tissue to find out what are some of the common traits among companies that for 15, 20, 30 years have handily outperformed the market. And how can we use those lessons to identify the next one?
Okay, so let's talk about this in the environment that we're in. Tariffs, there's a lot of uncertainty. There are tariffs that are in place. There are much larger tariffs that have been paused for, a few months here. Things have changed on the ground incredibly quickly. And we can expect that whipsaw and that uncertainty is likely to continue to be the case. But at the end of the day, that means 2 things for businesses. Number one, it's impossible to plan with any certainty what your cost structure is going to be, whether you're looking at expansion, you're looking at acquisitions, just planning your existing business. Everything seems to be a moving needle. But also, again, those impacts on the existing business. For a lot of those misfits that we've talked about, Tyler, these aren't necessarily high margin businesses to begin with, but they've done other things that have helped them become exceptionally profitable investments. So let's talk about what's happening now and what that means for so many of the companies that you follow and own.
Yes. I feel like there's two views of this, because there seems to be 2 groups of companies that tend to, fall into the categories of stuff that I write about. There's the ones that make stuff, and then there's the ones that do things that are, not physical, insurance, professional services, things like that, when we talk about tariffs, when we talk about foreign trade, these services businesses. I think we're going to set those aside for at least for a little while, because I think when we talk about tariffs, when we talk about the exchange of goods, the free flow of goods, services is in a slightly different realm. So we're just going to put those aside for a minute. Not to say that they're not affected in any way. We can touch on that, but they fall into two distinct buckets. And when we talk about the things that make stuff or sell stuff, this is where things get incredibly complex, because for the most part, if you look, it is hard to find a business in the United States today, or even overseas, I guess, if you will, that wouldn't be affected in some way by tariffs, for the simple fact that global supply chains have become so interwoven internationally that it to uproot that is to undo decades of work. This is not something like a company spun up a supply chain overnight. This is something that has been a meticulous decision over years and years and years of finding vendors and making sure that your delivery partners are all working together, and finding maybe there's a cheaper vendor overseas that can do it just in fast enough or something like that. And so when we're talking about the companies that they're manufacturers of goods, even if they are relatively simple things, it can have a profound effect on what they do. Obviously, there's ones of some of the ones that immediately come to mind are things like Dorman Products, which is a original equipment manufacturer for the automotive industry, which seems to be clearly in the line of sights for tariffs and things like that, because of content related to how much of your content is actually manufactured in the United States versus overseas. Things like this is going to make it immensely complex, and to the degree of being able to pass on cost to their customer, which in
So,
a case
Dorman, as an example, their business is they make largely their own branded, but they do some kind of white label stuff. It's the parts
yes,
that might go into like an AutoZone or a Napa or something like that, right? They're major suppliers for those companies.
right. And so what ends up happening is there's a possibility that they will be able to pass on the costs in some way to to Napa, or to name your automotive parts retailer that they're doing, because these tend to be aftermarket parts. But when it comes to sourcing the materials, or maybe they don't make every single piece that they make, they might have some third party arrangements with certain companies to manufacture a certain component. Anytime that Dorman is bringing something into the United States from overseas from one of these component manufacturers, they're the one signing the check, because the importer is the one that signs the tariff check to make this happen. And that can have a profound impacts on their business. And it's going to change the way that anybody makes strategic decisions on building new capacity. We talk a lot about building new capacity in the United States because that's a major capital decision, but it's also going to come down to major capital decisions on like how to renegotiate supply chains and things like that. And there's part of me that wants to try to explain it, but at the same time, I think you and I are in the same boat, where things have been moving so quickly that a lot of the statements that we're making and the things that we're trying to understand here are so fluid that it's hard to completely contextualize everything that's going on. And so as a result, you feel you're left a little bit perhaps unsatisfied with a lot of answers that you get from people on shows like this or in other places talking about tariffs, because let's be frank, we've never done this before, at least to this degree. So not in my lifetime. I mean, maybe my grandparents, when they were children, were, trying to experiencing a world where this existed. Most of us don't know what this world looks like. And so to, other than reading history books, which, might give us some sort of sense, but it's not going to tell us exactly how this is going to play out.
But I think there's a greater maybe message or point to thinking through this all the way from, asking a question to some people with a podcast or talking to your financial advisor, in that if you're looking for certainty in markets, you're always looking for the wrong thing.
I mean, yeah, it's like the point of equity investing is that very point is you're going for the most uncertain outcome. You're going for the riskiest outcome, in compared to, the bread and butter things that most people invest in, whether it be, CDs, sticking your cash under a mattress, bonds, or things like that, you are taking a more risky element. I mean,
Right.
we'll
When
not
there's a
we'll not
broader
talk
range of
about you and your
outcomes.
options, but
Yeah, but the bottom line though is that when there's a broader range of outcomes, there's a higher degree of risk,
right.
right? And that's just the nature of the way investing works. And the other side of that too is that with that broader range of outcomes, the range of outcomes in the positive light also expand into larger positive returns as well. Certainty, you pay a premium for certainty, right? You pay that premium, which means lower returns to get that certainty of return, that lower risk of losses. So thinking about misfits more broadly and the successful ones, what has set them apart? Again, we're talking about a unique environment now with kind of there's the key man risk right now with President Donald Trump, who is driving this entire initiative around tariffs and kind of by fiat is making the decisions about what the rates are going to be, if they're going to be in effect, if they're not going to be in effect, all of those things. And that's what's unique about this. But every company in the history of ever has had to navigate through uncertainty to a certain amount and the reality that whatever you plan, something's going to change along the way, right? Things are going to change. So, what are some characteristics you think of the companies that you've seen that have been successful across different economic cycles and different environments that set them apart?
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brent.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
And perhaps this is a little soapboxy of me to say that the common thread here, but as you've seen in the coming up on maybe 100 companies that I've profiled in some sense, either through IPOs or longer term profiles, one of the things that I tend to harp on and tend to have a common thread for most of them is some semblance of good governance reflected in the way that management and the board interact, the way that management is compensated for success, and things about corporate culture tend to be some of the most common threads across almost any industry, whether it be professional services, whether it be banking or manufacturing OEM products, or, there's some weird ones in there too that you've been probably reading it for a while now. There's a lot of companies where you just look at it, it's just weird, but they are successful in large part. And for the most of the ones that I have the most, I would say, conviction about, or the most confidence talking about, have been the ones that time after time after time have shown some sort of semblance in their corporate governance, corporate structure that is looking out for the best interest of all shareholders, particularly minority shareholders, which are, you and I. Companies that do these sort of things, that, want to compensate to grow the value of the per share value for you, tend to be the most successful to navigate all this. There's others that can be successful in selling things or growing making their business bigger, or making more revenue or something like that. But these have not always historically been the things that translate into value. And
Right.
so,
a company, for example, a company could double its earnings over 5 years, but if it doubled its share count to pay
you're
for
right
that,
back where you started.
you're right back where you started. Exactly. You could have a company that grew its earnings 10% over that same 5-year period, but bought back 10% of its shares over that same 5-year period, and earnings per share would be up roughly 20% over that same period, right? That's a better value, a creative business for the shareholder than the company that doubled its earnings.
Yeah. And so as a result, this mindset, or this corporate DNA, if you will, is so far, like, I haven't looked at every company in the world. I'll give it that. And there's still a lot of companies that I haven't, that are on the list of things that my to-do list, I guess, if you will. And perhaps, the signal will change. I'll readily admit that that's possible, but based on what I've done so far, I think it's a pretty decent sample size, is that this seems to be the guiding principle. Because, strategies come and go, technologies change, working conditions change, tariff environments change, interest environments change. But the guiding principle of, maintaining the value of the individual shareholders who own this business, and to have management incented to do that, tends to generate the best outcomes over the long term. And, I'm not saying that this means that all of the companies I've written about or talked about or discussed are going to be, tariff proof, or, are going to be able to deftly navigate this so well that, other companies are going to get left in the dust. Because honestly, there are some that I could be drastically impacted and might have to drastically change the way they do their business, and that could be very costly for them. But the guiding light, I guess, if you will, of them is to make a better environment for its shareholders. That's I think over the very long term, they'll at least figure something out over the long term.
So I want to build on a couple of things there, just as we've been talking through the idea behind this show over the past day or two. I think there are definitely some characteristics beyond that you've talked about before. Thinking about companies that, and it gets a little bit to Peter Lynch and Warren Buffett have both talked about. You want a business that the quality of the business can exceed the quality of the management. It's been described in a couple of ways. A ham sandwich could run it. A business that some idiot could run, because eventually some idiot will run it, right? There's all of those things come into effect too. But one of the things that you talked about is just a comment you made, is thinking about businesses that in these environments, we start thinking we need to find businesses that can thrive in this sort of chaos. And one of the things you talked about is just businesses that are just kind of built to survive these sorts of events. And it got me thinking about a few different things. But before I share, I'd like to hear kind of your thoughts about what prompted that specific description.
Well, I'm perhaps misquoting it, because I'm pretty sure that Charlie Munger said something along those lines of just finding companies that survive, rather than, trying to find the ones that are going to be the most successful over a, short to medium term. Because the theory always is over the very long term, something is going to blow up. Something's going to go sideways in either an anticipated or unanticipated way. And
Don't try to find the T-Rex, find the cockroach.
Yeah, good way of putting that, because the ones that are going to last through the business apocalypse are going to be the ones on the other side that are going to create value for investors. In that sense, companies that can survive, I mean, again, outside of management and the, trying to change their stripes, because a lot of companies that make goods are tend to be chameleons. They'll make something for 20, 30 years, and then they'll make something else. These companies that survive often tend to be in very durable things that we just need in our lives, not just, the hot tech thing that is, could be outdated 10, 15 years from now, or the trendy social media property that everyone is really hot on today. But, who knows what happens 10, 15 years from now. But there tend to be pretty durable things in our lives that we just kind of need, and companies that supply that tend to do incredibly well over the really long term. No, they're not going to knock it out of the park when the market's going 15, 20% a year and everybody is, clamoring for AI chips. But, we're always going to need septic tanks.
Yeah, I think that's exactly right. And just some examples to get the creative juices flowing for people out there. You mentioned Dorman Products for replacement parts for cars. And that's a company that's been essentially as successful as some of the best auto parts retailers, in recent decades. But you can look in the aerospace industry and you can find the same thing. It's companies that you have no idea who they are, but you know who Delta and Southwest are. And these are the companies that keep them up and running, keeping those planes in the air, that have carved out a niche. It's a big enough niche, and they've carved out great profitability. But they're the product, the service that they provide to their, in this case, the airlines, is far more outsized than the impact on the operating statement for those businesses. That they're not going to shop around to save 5% because they know they have a vendor that they can count on to make sure their planes are in the air and generating revenue, not costing them money and blowing up their entire flight schedule because they're having to wait an extra 5 or 6 hours on a part. So yeah, I think that's a good example. Again, you're talking 20, 30 plus year life cycles for these aircraft. So very, very durable sort of businesses. But one of the things that it got me thinking about too, the idea of being built to survive, not thrive, is sure, you want companies to have balance sheets that are stable, that can get through these economic shocks, where the company's not going to have to go hat in hand to the markets to raise cash at a terrible time to be doing that, when they're going to be taken advantage of because the capital providers out there can, but not having so much cash and so much excess on their balance sheet that it's unproductive, right? Because you build those businesses that are built to just float through these sorts of environments. They're missing the bigger opportunity, which is when the market's growing, when the economies are healthy and there's opportunities to consolidate and expand, right?
Yeah, and it's almost a little bit of that, don't tempt the robber by putting all the money outside on the front step of the bank. The idea of if you leave these massive, massive cash piles sitting dormant on a business, management's going to get probably an itchy trigger finger to
Right.
want to do something with it in some way.
And they're probably going to do something dumb the bigger the pile of cash gets.
Yeah.
So Tyler, we've talked about the businesses so far here, kind of from the board down with the corporate culture and the management, but also the incentives. Lord knows you've talked a whole lot about looking at proxy statements and understanding how management is incentivized executives around things that create value for shareholders, not just building the empire bigger without creating per share value. Some of the characteristics in terms of the businesses that are just kind of built to figure it out, right? And those are all important things. But I think one of the other things that we really try to do a lot on Investing Unscripted, that's not as much a part of what you're doing with Misfit Alpha, but that we do need to talk about, is how do you as an investor think about these sorts of environments?
Well, I feel like when you're thinking about these sort of environments only right now, that was perhaps a flaw in your investing thesis when you made your original investment. And I don't mean that to be critical, but it's this idea of not when you look to buy a company, you look to go own shares of a company, you're not only looking at what is the potential for this to grow, but you're also looking of what can go wrong. And in doing so, when you're conducting your investment thesis, doing your investment research on these particular companies, not only do you have to know why it's going to succeed, you also have to know how is it going to, how much are you willing to let it go sideways based on what you're doing? And can you, as the investor, get value from a less than ideal situation in this business? And that comes down to, conservative, to use Wall Street parlance, I guess, if you will, is to conservatively underwrite what you're doing at the original investment. Not just looking for the high growth companies where you got to pay up a premium for growth. Well, you're paying up for a premium of growth when the growing's good. Are you paying up for growth when the growth is bad? And that's where it starts to get into this whole point of kind of going back to that idea of not just just surviving, not thriving, is is the idea that, the investments that you make and the decisions that you make for your portfolio aren't just built to, generate 15 to 20% returns every year because the market's going great. It also, it has to be able to withstand significant drawdowns to be able to, go sideways, if you will. And a lot of that result is going to be baked into your original investment thesis. If you are buying the hottest company out there that is trading for very, very lofty expectations, perhaps excessive, one small shred of that, optimistic view gets, skewered, things can go sideways pretty quickly. And that's the whole, going back to, probably you and I's favorite, Charlie Munger, is, look at it from the other way. It's like not all, not just like how is a company going to do awesome, like what's going to wreck this company and how bad can it get? And that has to be just as much a part of your investment thesis as is why this is going to do well for you.
Yeah, I think that's right. It's funny, as you were talking, the two things that I was thinking about, number one is that I think most investors would be served if they just inverted their investing process, just inverted their entire thesis, and spend the amount of time you're spending today looking for thesis proving things, spending that time looking for holes in the thesis, what could go wrong. We would be far better served to be able to get through these sorts of environments as investors without causing unforced error, harm, selling, trying to avoid the worst of downturns, trying to time our way around these sorts of periods. And you said something that really gets to the heart of it too. You don't anticipate, you underwrite. And that's paraphrasing what you were just saying before. But to build on that, I think one of the mistakes we make is we try to use too much precision with anticipating what could go wrong, instead of acknowledging that something will go wrong. And how much margin of safety have we built into a combination of the price that we pay, the amount that we allocate towards that particular investment, and the amount of time that we're prepared to hold, right? Those three things all really, really matter to getting through rough times with our investments and avoiding downside risk for ideas where the probability of outcomes maybe skews more towards more of the bad outcomes than more of the good outcomes. I think it's a combination of those three things. So again, not anticipating with precision what's going to go wrong, but underwriting our portfolios in a way that we reduce the downside risks while trying to maximize the upside.
Yeah. And the thing that comes to mind when you mention the anticipation thing, one of the things that I found was very useful in determining what is a good management compensation structure, or what is a good board corporate governance look like. Because let's be frank, there isn't a lot out there in terms of financial writing, in terms of financial media, that talks about governance and good management practices and good management incentives. It's a weird, quiet place. I mean, even like some of the books that we idolize, like the Philip Fishers and the Peter Lynch's and the Benjamin Grant, they barely mention, corporate governance and things like that. And so it's a territory that is for a lot of investors hard to wrap their minds around, because not a lot of people have written about it. And
well, I promise you, there are a lot more recipes about the best barbecue you'll ever eat than there are about how to make yummy Brussels sprouts.
That is very true. I mean, I think we're getting better on the yummy Brussels sprouts these days. I think that's a nice evolution in our food worlds, but that's an aside. So getting back to well, how do we anticipate, or is kind of like scenario building in like looking at these sort of things, is what happens if you take this to the most perverse place?
Yeah.
I know it doesn't sound great when you put it that way, but in kind of, again, Munger thinking, I guess, if you will, is like, if I were given this incentive and take it to the most perverse place possible, what happens? And you can see the flaws in a lot of the way that, people are compensated. And even the things that are good can be bad if taken to the most perverse place. And so it's all about understanding the dynamics of how all those things work together, that you can kind of start to figure out how to evaluate these things over the long term, and how to evaluate these things for a successful investment. Because you start to like, if you look at it from one way, it's like, well, I only want growth. And you're like, well, they can do that, but they might issue a lot of stock to do that, or they might take out a lot of debt to do that, or, chase unprofitable customers because it'll make revenue grow up. That's the most perverse place. Oh, I only want returns. Well, the way you get the most returns is you don't invest in your business and you just
Right.
milk it for cash. And
Well,
that's,
and that's how you
cigar
end up.
butts.
That's how you end up with a Boeing or a 3M.
Yeah. Or a Kodak,
Right.
or something like that, where, businesses just try to milk it for cash and then it goes nowhere, and things like this. And so by building scenarios like that, inverting, taking it to the not just looking at the good side, but also looking at the bad side, taking one element, projecting it out to a perverse place, looking at the opposite element. These sort of things, I know it sounds silly, but it is a very powerful mental exercise for everybody who's looking at investing to, do these mental exercises with the companies you invest in, because it'll help you better understand the levers that they can pull and what will make them successful.
Yeah, I think that makes sense. Let's take a minute here and let's take the last few minutes here and let's get a little bit in the weeds and talk a little bit about actual investments and what we're looking at right now and what you think is compelling. What's on your watch list?
We can do this in two ways. We can do this in the, what are some of the bread and butter things that most investors will look at, or we can go, we can turn Tyler up to 11 and go to weird, obscure places that he's looking at. But if we're thinking about tariffs, we're thinking about uncertainty, we're thinking about the impacts that this could have on the flow of goods, the flow of businesses, the way that they're doing things. Again, this is a very goods related side of business. There's actually, I'm starting to look more and more on services, professional services businesses that, aren't going to be quite as affected, might be some of like the technical people that they will bring in to consult on, how to implement AI in your business, or how to, set up automated systems for manufacturing or something like that. There's a small coterie of businesses out there. I don't want to say the McKinseys of the world, because McKinsey is not a publicly traded company, but there are professional services companies out there that are designed to do these sort of functions, outside consultancies and things like that are built to help companies adapt to these changes that they're going to be experiencing, and how to reorient supply chains, or how to, as I said, help better automate your facilities and things like that. I think there is a world in which these types of businesses will thrive, at least in this particular scenario. Not to say that they won't, thrive in any other environment, but
that's a key thing that you just said right there, is that there could be opportunity as a byproduct of what's happening. But these are businesses that are already built to succeed.
Yeah. These are most like professional services consulting companies. They do a wide array of things. It can be like, best way to like efficiently, handle overseas taxes, or, how to handle a downsizing, or how, to help with hiring and firing of people, how to implement AI. There's one of the businesses I've wrote about, actually two. I'll mention two that I've written about with Misfit Alpha that immediately come to mind as I think of FTI Consulting, which is basically like a restructuring and bankruptcy consultancy. These are the type of businesses. I'm not saying that companies are going bankrupt, but there's corporate restructurings that aren't bankruptcy related that I'm sure that people are going to be needing in times like this. But the regular ups and downs of businesses always needs this sort of consultancy work. And Excel services, EXL services, it's all one word. Same thing. They're kind of a contract service outsourcer. They're kind of like one of those. They started off as like a call center in India, and they started doing like contract underwriting for insurance, contract claim servicing, healthcare claim servicing. A lot of those sort of businesses that have been outsourced to like call centers in India, they're also making big pushes into like how to do AI implementation. And so I think businesses like this, which have been successful over a very long period, are likely to be ones that are going to be successful in these sorts of environments. How long these environments go, we don't know. But the nice part is like I said, these are businesses that over the very long term have done incredibly well. And this just happens to be the environment in which they will do well. If we were to go really deep into Tyler's obscure world of stocks, like I think I've mentioned it to you before a couple other times, is starting to look at, manufacturing outside of the United States, especially some of the concepts that have been so prevalent here in the United States, reshoring, building up manufacturing capacity, especially advanced technical manufacturing. I'm starting to do some of my initial legwork to see if that sort of process can be implemented elsewhere, because if everyone becomes localized, there are going to be local suppliers and picks and shovels plays in things like reshoring, manufacturing, AI implementation, things like that, in Europe, in Asia, and things like that. And obviously that's going off into not stocks that aren't traded on American exchanges, but I think there's going to be some interesting opportunities here in those sort of places in the coming years. And it's going to take a lot of legwork to find them, but that's one of the things I do enjoy is the legwork.
So I've been taking a little bit of a different approach, and two different things that I've been looking at. One is I really love it when companies that have a proven business model and they've carved out a niche that they're exceptionally good at and it's profitable. And during normal economic times, which is normal most of the time, they outperform. They do exceptionally well. And when we go through periods like this, the market just gets a little wacko and the stocks take a beating, and we get opportunities to buy. And I'm perfectly happy to buy those businesses, even though their near-term outlooks are muddy to bad, right? So a couple that I've bought recently that I'm big fans of, one is First Solar. This is a stock you and I both own and have covered for a long time. And it's a rarity in that it's a solar panel manufacturer that's actually made investors money over the long term. Exceptionally good capital allocators. They're built to thrive when the market is strong, and they're built to get through it when it's not, and continue moving forward with their capital plans. So First Solar has done exceedingly well. Banks are getting weird and some are getting interesting. Like Live Oak Bank now trades for basically its tangible book value, which is incredibly attractive. Small businesses, which is their primary, that's who they lend to, could have a hell of a tough next year or two. And that could affect Live Oak. But I do think this price, again, basically being able to buy the bank for book value, is exceptionally attractive for a 5-10 year plus hold. So I've done that. And also I recently, after following it for a long time, I finally bought shares of QXO, which is Brad Jacobs' new roll-up business that's targeting the building products industry. And I think we're in a situation now, because of the chaos, there could be some opportunities for Jacobs and his team at QXO to move pretty quickly. They've announced their first big deal, their first acquisition. And I expect that we will probably see multiple more deals happen this year, particularly if we go into a weak economy, if these tariffs really come in, because a lot of these distributors are small businesses. The margins are very, very thin, and there could be some opportunities for QXO to make a number of acquisitions relatively quickly. But if you look at his history, sometimes you find like the great manager who has a formula and they're damn good at it, and they've created a lot of value for investors over the years, and you give them, take my money, Brad Jacobs, right? So I think the opportunity has gotten compelling. And the day that we're recording this, I actually bought shares. So it's gotten really, really compelling. There's risk here, execution risk for a strategy like this. But so that's the approach that I've taken recently, Tyler.
The minute you said, companies that do well in normal times that get absolutely whacked, I came to mind of like this very like cottage industry that I wrote about a while ago. Basically, like the suppliers to the RV and boat industry, because this is one of those industries where when things go bad, it goes bad really hard and fast. And these are companies that, at certain times have traded for like less than 0.1 times their book value, because everyone thinks that they're just headed to the dustbin. And somehow like have been able to get through it, and it's quite fascinating. There are all these cottage industry, if you will, not the actual ones that make like RVs and boats, but just make all of the components in them. Very similar to a Dorman Products, but it's just for RVs and boats. One of the companies, I think it's Patrick Industries, is one of them. These are businesses that have seen 70, 80, 90% drawdowns in their stock in their like corporate life cycle, and still today are market beating companies. It is a fascinating strategy that if you can execute it well, you can do spectacularly. But oh boy, that's one of those ones where it's like you have to have a different type of stomach to own them than your normal company.
That's right. Yeah, the intestinal fortitude is not a South Korean sedan. You got to have the guts for those kind of companies. That's for sure. All right, Tyler, any last words before we wrap the episode up here?
I feel like we may be hammering the same points home, but that's what we do in financial media anyways. But I think when one of the themes that I'm always going to harp on, and we're probably going to spend at least 10 minutes on these, is going to be talking about incentives, talking about management and corporate culture and why those things matter. And I know there's probably a lot of eye rolls, but I think it's just one of those things that over time, the longer you're in the market, the more people care about it.
Yeah, I think that's a good way to end it, Tyler. So thanks again for episode 3 here. Just a reminder, everybody, we're going to do an episode of Misfit Monthly once a month, and it's going to typically drop kind of mid-month like we're doing right here. So Tyler, look forward to doing this again with you next month.
Looking forward to it.
Okay, friends, if you're looking for more from Tyler, go to misfitalpha.com. Check out the link in the show notes. You can get that. And remember, if you click on the link in the show notes, it's going to bring you to a page where you can get a discount off of the paid side of Misfit Alpha. So be sure to use that link if you want a discount. Definitely check it out. Either way. Also check out investingunscripted.com. It's the newsletter that we do here. Usually words from me. Jeff also shares something every once in a while. Sometimes we share words from podcast guests as well. So check that out. Sign up for that. Stay tuned for our regular episodes of Investing Unscripted every Wednesday. Always just remember, we love to give our answers to these hard questions about investing. Do your own due diligence. It's up to you to find your own answers. All right, everybody. We'll see you next time.